In July of 1997, the Central Bank of Thailand does something it had been trying to avoid for weeks. It stops defending the value of its currency, the baht. Within hours, the baht loses a sixth of its value against the dollar. Within weeks, international investors panic and begin pulling their money not just from Thailand but from the entire region. The Philippines, Malaysia, Indonesia, South Korea. Countries that had been celebrated for years as economic miracles, the Asian tigers, discover that the foundations of their prosperity are far more fragile than anyone believed. A year later, in September of 1998, an investment fund run by two Nobel Prize-winning economists is on the verge of collapse. Its losses are so large they threaten to destabilize the global financial system. Every crisis has a lesson. But sometimes the lesson is forgotten before the next crisis arrives. In the previous episodes we have covered the great crises of the 20th century, the 19th century panics, the Great Depression, the New Deal, Bretton Woods, oil, the Soviet collapse, the 2008 debacle. In this final episode of the season, we will examine four more crises that complete the map. The Asian crisis of 1997. The collapse of long-term capital management in 1998. The European debt crisis of 2010. And the economic shock of COVID in 2020. And we will look for the patterns. Because crises are different in their details but astonishingly similar in their structure. To understand the Asian crisis you have to understand a concept, hot money. It is international capital that flows into a country seeking high short-term returns and that can leave just as quickly as it entered. During the 90s, the countries of Southeast Asia, Thailand, Indonesia, Malaysia, the Philippines, and also South Korea, experienced a boom in foreign investment. Their interest rates were higher than in the West. Their currencies were pegged to the dollar, which eliminated exchange rate risk for investors. And their economies were growing at impressive rates. The money poured in. But much of it did not go to productive investments. It went to real estate bubbles, to projects of doubtful profitability, to loans that should never have been made. Local banks borrowed in dollars on a short-term basis and invested in long-term projects in local currency. If the exchange rate held, everything worked. If the currency devalued, dollar-denominated debts became unpayable. And that is exactly what happened. When Thailand let the baht float on July 2, 1997, foreign investors fled the entire region. Currencies collapsed. The Thai baht lost 56% of its value. The Indonesian rupiah fell 81%. The South Korean won, 48%. The consequences were devastating. In Indonesia, gross domestic product contracted 13% in a single year. Unemployment soared. Food prices doubled. Riots spread and President Suharto, in power for 32 years, was forced to resign. The International Monetary Fund intervened with a rescue program of $40 billion for Thailand, Indonesia, and South Korea. But the IMF packages came with harsh conditions, fiscal austerity, high interest rates, structural reforms. Many economists argued that these conditions worsened the crisis rather than relieving it. In September of 1998, while Asia was still licking its wounds, another crisis erupted in an unexpected place, an investment fund called Long-Term Capital Management. LTCM was not just any fund. Its founders included John Meriwether, the legendary bond trader from Salomon Brothers, and two Nobel Prize-winning economists, Myron Scholes and Robert Merton, the creators of the Black-Scholes model for pricing options. The fund used extremely sophisticated mathematical models to identify small discrepancies in bond prices and bet that those discrepancies would close. The profits on each trade were tiny, but LTCM amplified them with colossal leverage. By the end of 1997, the fund held about $30 of debt for every dollar of its own capital. The first years were spectacular. Returns of 20% in 1994, 43% in 1995, 41% in 1996. Then, in August of 1998, Russia devalued its currency and defaulted on its debt. Investors around the world panicked and rushed to the safest assets. The small price discrepancies LTCM was betting on, instead of closing, widened enormously. The fund lost 44% of its value in August alone. With leverage of 30-1, those losses meant bankruptcy. And LTCM's bankruptcy threatened to destabilize every major bank in the world, which were its counterparties in thousands of trades. The Federal Reserve organized a rescue. It did not put up public money, but it gathered 14 banks and investment firms that contributed $3.6 billion to prevent the collapse. The fund was wound down in an orderly fashion. The lesson was clear: mathematical models do not eliminate risk. They hide it. When markets behave in ways the models did not anticipate, losses can be catastrophic. And excessive leverage turns any problem into an existential crisis. 10 years later, in 2008, the same lesson would have to be learned again. On a much larger scale. In October of 2009, the new Greek government revealed that its budget deficit was 12.5% of gross domestic product, more than triple what the previous government had reported. Public debt exceeded 110% of GDP. Rating agencies downgraded Greek debt to junk. The market shut off the credit tap. And what could have been the crisis of a small Mediterranean country became the biggest survival test for the euro as a project. Because Greece shared a currency with Germany, with France, with the Netherlands. It could not devalue its currency to regain competitiveness, as Thailand or Argentina had done. It was trapped in a monetary union without a fiscal union. The so-called Troika, the European Commission, the European Central Bank, and the International Monetary Fund, organized successive bailouts, 110 billion euros in 2010, 130 billion more in 2012, a third in 2015. In exchange, Greece implemented brutal austerity. Massive cuts in public spending. Tax increases. Reductions in pensions and public sector wages. Greek gross domestic product contracted a cumulative 25% between 2009 and 2015. Unemployment reached 27.5%. Among young people, it exceeded 60%. The humanitarian crisis was real: hospitals without supplies, overwhelmed food banks, rising suicides. The debate over whether austerity was the right answer deeply divided Europe and the academic world. The German position and that of the IMF, at least initially, was that Greece had spent too much and had to adjust. The Keynesian position was that imposing austerity on an economy in recession only deepens the recession, creating a vicious cycle where cuts generate less tax revenue, which generates more deficit, which generates more cuts. Ireland, Portugal, Spain, and Cyprus also needed assistance. The crisis proved that a monetary union without mechanisms of fiscal solidarity was inherently unstable. And that the line between a financial crisis and a humanitarian crisis can be very thin. In March of 2020, something no economic model had anticipated halted the world economy. It was not a bubble or a financial panic. It was a virus. To slow the spread of COVID, governments around the world ordered the closure of businesses, the cancellation of travel, and the confinement of their populations. Economic activity collapsed overnight. In the United States, gross domestic product fell at an annualized rate of 30% in the second quarter of 2020. In April, more than 20 million jobs were lost. Weekly unemployment claims went from 256,000 to 6 million in 2 weeks. Numbers that seemed impossible. The fiscal response was unprecedented. The United States approved stimulus packages worth more than $5 trillion. Direct checks to citizens. Massive expansion of unemployment benefits. Forgivable loans to businesses. The budget deficit soared to 16% of GDP, the highest since World War II. The European Central Bank, the Federal Reserve, and other central banks injected liquidity on a scale that would have been inconceivable before 2008. Interest rates were held at zero or below zero. Trillions were spent buying public and private debt. The recovery was surprisingly fast in macroeconomic terms. But it left scars. The inflation that followed in 2021 and 2022 was, in part, a consequence of the massive stimulus combined with supply chain disruptions. And the debate over whether the response was excessive, insufficient, or simply different from what it should have been remains open. If this season proves anything, it is that financial crises, despite their differences, share a recognizable structure. First, a period of euphoria. Easy credit. Rising prices. The conviction that this time is different. That the old rules no longer apply. Second, excessive leverage. Borrowing to invest amplifies gains on the way up and losses on the way down. From the margin purchases of 1929 to the CDOs of 2008, the pattern is identical. Third, the moment of truth. A trigger, sometimes minor, that unleashes panic. A bank's default, a price drop, the revelation of a fraud. And then contagion, because everyone discovers at the same time that the risks they thought were under control were not. Fourth, the social consequences. Unemployment. Poverty. Lost savings. Distrust in institutions. Financial crises are not abstract events. They are millions of individual stories of suffering. And fifth, the response and the reform. New regulations. New institutions. New promises that it will never happen again. Until the memory fades, regulations are relaxed, and the cycle begins anew. There is a cruel asymmetry in financial crises. Those who take the risks and those who suffer the consequences are rarely the same people. In the Asian crisis, the executives of international investment funds who pulled out their money lost a percentage of their portfolios. The Thai and Indonesian workers who lost their jobs lost everything. In the European debt crisis, the French and German banks that had lent irresponsibly to Greece were protected. The Greek retirees who saw their pensions cut in half were not. In the pandemic, technology companies saw their profits soar while workers in the service sector, delivery drivers, waiters, and shop assistants suffered the lockdowns disproportionately. Every crisis is a reminder of an uncomfortable truth: the economy is not a symmetrical game. Risks are not distributed equitably. And the reforms that follow crises, however well-intentioned, tend to protect first those who are already protected. The question every society must ask after a crisis is not only how to prevent the next one, but how to distribute the cost fairly. And that is a question no mathematical model can answer. 4 ideas to take away from this episode. First, the Asian crisis of 1997 demonstrated the dangers of hot money and of pegging currencies to the dollar when the fundamentals did not justify it. Contagion devastated the so-called Asian tigers in weeks. Second, LTCM showed that the most sophisticated mathematical models do not eliminate risk, especially when combined with extreme leverage. The same lesson would be ignored 10 years later in 2008. Third, the European debt crisis proved that a monetary union without a fiscal union is inherently unstable. The debate between austerity and stimulus divided the continent and had severe humanitarian consequences. Fourth, COVID was an unprecedented external shock that generated the largest fiscal and monetary response in history. The speed of the recovery demonstrated that massive intervention works, but the inflation that followed was a reminder that every intervention has costs. Every crisis this season was shaped by one force: the connections between economies. Trade routes, capital flows, supply chains. In Season 10, we will trace how the world became a single interconnected economy, from the Silk Road to global supply chains, and what that means for all of us.